Healthcare Institute Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suraj Digawalekar from CDR India. Thank you, and over to you, sir.
Thank you, Raman. Good morning, everyone, and thank you for joining us on Max Healthcare Q2 and H1FY24 earnings conference call. We have with us Mr. Abhay Choi, Chairman and Managing Director, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Keshav Gupta, Senior Director Growth, M&A and Business Planning. We will begin the call with opening remarks from the management, following which we will have the forum open for an interactive Q&A session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
A very good morning to everyone. We are pleased to welcome you to Max Healthcare's earnings call for the second quarter and first half of fiscal year 2024. Let me start by stating that our performance in the first half of the fiscal year has set a commendable precedent for us to follow in the latter half. We recorded a year-on-year increase of 17% in network revenue and 20% in EBITDA in H1, while Q2 turned out to be the 12th consecutive quarter of year-on-year growth. Our Q2 performance this year largely mirrored our quarter-on-quarter performance last year, alluding to the steady state of our operations as well as secular demand for quality healthcare services. Further, our granular focus on execution and capital allocation, as is evident from our pre-tax ROC of 38.3% in Q2, we are well poised for the next leg of growth that is set to come from planned capacity expansion as well as inorganic opportunities. On that note, we are happy to share that the developer of our upcoming hospital in Dwarka has applied for the occupancy certificate, which is a significant milestone, is actually the final milestone, and we expect to commission the same in the fourth quarter of the current year. Moreover, our most recent brownfield expansion, Max Shalimar Bagh, has reported an overall average occupancy of 78% on a year-on-year revenue and EBITDA growth of 41% and 48% respectively in the second quarter. On the clinical front, we have signed memorandum of understanding with Q2 Surgical, the US-based pioneer of robotic surgical systems, to establish Southeast Asia's first total program observation center located at our Max Saket facility. The center is expected to have positive impact on both India and Southeast Asia's surgical healthcare ecosystem by enabling healthcare professionals to drive advancements in patient care using robotic-assisted surgery and elevate surgical healthcare standards in the region. Now, moving on to the highlights of our second quarter performance. Occupied bed days grew by 3% year-on-year and 5% quarter-on-quarter, reflecting an average occupancy of 77% for the quarter. 93% of the year-on-year and 118% of the quarter-on-quarter increase in occupied bed days was driven by preferred channels, which is cash, insurance, and TPA, and international. With increase in occupied bed days and marginal drop in ALOS, the inpatient discharges were up by 7% year-on-year. Even OP volumes exhibited a strong growth of 14% year-on-year and 4% quarter-on-quarter. Institutional bed share fell to 27.3% compared to 27.9% last year and 29.7% in Q1 this year. However, after excluding Max Shalimar Bagh, the most recent expansion, the overall institutional bed share stood at 25.4% during the second quarter. Average revenue per occupied bed for the quarter stood at 74,600, growing by 13% year-on-year and remaining flat quarter-on-quarter due to seasonality. Year-on-year improvement was witnessed across all specialties, with oncology being the key driver. Network gross revenue was 1,827 crores compared to 1,567 crores in the second quarter last year, and 1,719 crores in the previous quarter. This reflects an increase of 17% year-on-year, led by growth in ARPOB and occupied bed days. Quarter-on-quarter growth of 6% is mainly driven by increase in OBDs, occupied bed days. Revenue from international business again grew significantly by 25% year-on-year and 11% quarter-on-quarter, accounting for now around 9% of the total revenue from our hospitals. During the quarter, we have operationalized company-owned patient assistance centers in Nepal, while all formalities for the Bangladesh center have been completed. We expect to operationalize this center shortly. This is in spite of the Afghanistan business, which was 12% of our total international business, is down to zero. Direct costs were lower quarter-on-quarter due to increase in medical patients attributable to seasonal vector-borne diseases. On the indirect cost side, while the overall percentage was lower, there was an increase in absolute costs, primarily due to marketing costs for international channels and seasonal increase in power consumption. Network operating EBITDA stood at 497 crores, just below the magic mark of 500, reflecting growth of 21% year-on-year and 14% quarter-on-quarter. Accordingly, the operating margin increased to 28.7% versus 27.7% in the Q2 last year and 26.8% in the previous quarter. Most importantly, annualized EBITDA per bed rose to 75 lakhs, yet again our highest ever, clocking a growth of 70% year-on-year and 7% quarter-on-quarter. Profit after tax was 338 crores versus 267 crores in Q2 last year and 291 crores in the previous quarter on a like-to-like basis. The year-on-year improvement of 26% was primarily attributable to flow-through of improved EBITDA and lower finance costs. Free cash flow from operations was significantly higher this quarter at 456 crores, of which 90 crores was deployed towards ongoing capacity expansion projects. Net cash position improved to 1,303 crores at the end of September 2023, compared to net cash of 42 crores same time last year. Continuing efforts to support the local communities, we treated approximately 39,000 patients in OPD and 1,300 patients in IPD from economically weaker sections. On the growth trajectory, Max at Home reported a top line of 42 crores, reflecting a growth of 23% year-on-year and 8% quarter-on-quarter. We continue to receive good feedback for our services, and the same is reflected in the SBU's revenue growth. Max Lab, the non-captive pathology vertical, offers its services in 36 cities and now has an operational network of over 1,000 collection centers and active partners. This SBU reported a gross revenue of rupees 39 crores, reflecting a like-to-like growth of 32% year-on-year and 15% quarter-on-quarter. Now coming to the status on the upcoming expansion projects. As most of you know, 122 beds at Shalimar Bagh have been operationalized at the start of this financial year, and as mentioned earlier, the hospital reported an average occupancy of 78% for the quarter. For 300 beds at Dwarka, application for OC, which is occupancy certificate, has been submitted in October end. Majority of the interior works have been completed, and some of it is just being finished as we speak. We expect to commission the hospital in later half of Q4, subject to receipt of occupation certificate by the developer. And 29 beds at Nanavati. Excavation and raft work are complete. Steel fabrication up to the ground level and slab work have also been completed. Ground level structure is expected to be completed in the current quarter, and the project continues to be on schedule. For 300 beds at Sector 56 Gurgaon in phase 1, the D-wall has been completed and the site excavation is almost done. The EPC contractor is already on board and design and development is under process. PDR approval for additional 0.5 FAR has been received and the project is on schedule. For 190 beds at Mohali, the D-wall is completed and excavation work is underway. All statutory approvals to start the construction have been received, and the project is largely on time. Well, almost entirely on time. The EPC contractor has been mobilized, and the design development is in progress. The 350 beds at Max Smart in Saket, which had seen some delays initially, we have now initiated the process of transplanting the trees that permission had taken some time to come, which are now, this has been on the critical part, but now the project is back on schedule and work should start by December current year. For 300 beds at Vikrant, at Saket complex, environmental clearance has been received and the submission of drawings to the Municipal Corporation of Delhi is in process. For 250 beds at Patparganj, drawings have been submitted to the Municipal Corporation of Delhi and the application for environmental clearance has been submitted. So all the other projects are on schedule. There is no delays as such. And finally, coming to the overview of the company's performance in the first half of this financial year, network gross revenue stood at 3,546 crore, reflecting a growth of 17% year-on-year. Network operating EBITDA grew by 20% year-on-year to 933 crore. Increased ARPOB, improved case mix and augmentation of network bed capacity by 130 beds resulted in margin expansion to 27.8%. While EBITDA per bed grew by 15% to 72.8 lakhs per bed. In the first half, we generated rupees 697 crores of free cash flow from operations after interest, tax, working capital changes and routine capex, of which 128 crores was deployed towards ongoing expansion projects. With this, we open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, good morning, and thank you for the opportunity. My question is, you continue to see progress in reducing bed share to institutional patients. So, a few quarters back, you had given an indication that you would like to bring it down to the industry level. But with Shalimar Bagh, I guess you have taken on more institutional bed to ramp up occupancy, etc. So, do you still target to bring it down to, say, industry average, and when it will likely happen?
I mean, there is no industry level, so to say. There's no classified industry level. I think it's highly sort of changes between metros and non-metros. You have more PSUs, headquarters, etc. out of places like Delhi NCR. So you have a larger sort of importance of that. Larger amount of businesses coming through. Now, 2-3 things have happened. One is apples to apples from 29.7%. It's come down to about 25% in the current quarter. Second is that it's on an increased capacity, including Shalimar Bagh, which has happened. Thirdly, certain rates have moved up, in which, because in CGHS, and we're expecting certain other rates for institutional business to move up in the current quarter, because of which little bit you would have taken the foot off the accelerator. And finally, even within the institutional business, there's been a churn in the sort of specialities we are catering to and the ones we are not catering to. And all of it sort of comes down and plays out in your higher EBITDA. So what you're seeing is, although because of the overall capacity constraints that we have, your occupancy has moved up by only perhaps 3% year on year, but there's been a churn of about 3 to 4% year on year also within the payer mix, and all of that is then translated into a higher percentage margin as well as EBITDA per bed. So to say, apples for apples, the same inventory going forward will be coming down as far as institutional business is concerned. But to your point, as you rightly mentioned, as and when you have new capacities coming, those capacities initially will have increased in institutional business. So in percentage terms, it may move up, but or remain stagnant just when those capacities come in. But I think overall it still translates to your better EBITDA margin.
Okay. So you mentioned
just to sort of complete that point.
Yeah.
You may have seen because of Shalimar Bagh, new capacity coming in, the institutional business sort of moved up. But if you actually see the EBITDA coming from those incremental beds, in spite of basis this increase in institutional business is yet 40% margin.
Okay. So that means obviously you are getting much better realization from these set of patients also. As you mentioned, wage hike in CGHS could be one of the reasons which might be contributing, and then obviously specialty mix. Just
not that. This is largely because of the operational efficiencies that you have. You have huge operating leverage in the new beds. You don't have the fixed cost, etc. So what happens is even the lower mix, right? The lower payer mix, becomes more viable and more viable even on the new sort of beds. So your operating cost is very low on the incremental.
Okay, so it's primarily driven by efficiency, as you mentioned. Like you have better absorb the overheads there. That is resulting in these kind of numbers.
That's right.
Okay, and just a clarification. You mentioned there has been a bit of hike on the CGHS patient also. So right now, what is the difference between that price channel and then the normal cash and others? Very broadly, what is the yeah?
So typically, if you take the ARPA of the two channels, they will be so the CTI channel, the preferred channel is 85% higher than the PH channel.
Almost 100% higher. Yeah.
No,
85% higher.
So the preferred channel is 85% better ARPOB than the...
If your PSU ARPOB is 100, this will be 185.
Okay, 100 and 100. Okay, my last question is your difference between gross revenues and net revenues, which you book for pro forma financials, that's primarily driven by what you pay for EWS patients, right?
Yes.
So,
that's right. Yes. Largely that's the number, yeah.
Yeah, and I'm seeing that number has broadly remained somewhere like 5% of gross revenues. So should we assume similar numbers to trend, even if, say, we are commissioning new facilities ahead, and then according to government rules, we have to allocate some bed for the EWS?
Dwarka may not have any EWS obligation.
It does not have.
Dwarka does not have.
Mumbai will have, and others will have. Gurgaon won't have.
Okay, so Dwarka and Gurgaon does not have.
Other than Gurgaon, Dwarka and Mohali.
Yeah. All others will have.
Okay. Thank you.
20 to 100 additional beds.
Mm-hmm.
I think between these you have 200 in Mohali, 300 in
1,000 beds.
1,000 beds you will not have. Balance 20 to 100 will have. Sorry, balance 1,200 will have.
Approximately 1,200 beds will be utilized, and then others don't have such requirement.
Yeah, so let's say we have 2,200 beds further coming up.
Mm-hmm.
2,700 beds further coming out, of which 1,000 beds will not have any EWS obligation. And the balance 1,700 will have that 10%, so let's say 170 beds out of 2,700 beds.
Okay, got it. Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Thank you for the opportunity, sir. First, on the housekeeping question on the international patient bed share, what was that for the quarter?
Yeah, so that will be around 5%.
5% only.
Yeah. Because the ARPA is higher, so that's how the revenue share goes up. So it's that experience 5.5%.
5.5%. Okay. So then probably the pricing, etc., kind of more or less has remained same. Okay, thanks for that. And secondly, when I look at our specialty mix, oncology therapy, if I see, has been growing at almost 2x the overall revenue growth, at least for the last 2 quarters. And even if I look at a longer term trend, for the last 9 quarters in a row, it has grown faster than our overall revenue growth. So what are we doing differently there? Is it a market growth or?
Yeah, I think overall growth is 17%. This is about 26-28%. Not exactly double. But there's been a focus on oncology, and we've also seen a larger burden of the disease sort of this thing playing out. We've also had a focus on robotics, etc. And as we are moving up the value chain, what we're seeing is more and more people are choosing more sort of better technology.
Okay. And
also seeing, as you're seeing more and more circulation of insurance, then people tend to sort of, for higher end things, etc., do less of window shopping. They go to more established corporate hospitals and brands. So we are seeing more and more people for oncology and some of the other things, whereas they would have gone to smaller places earlier, now coming to larger hospitals. So insurance plays an important part.
And so now also oncology tends to have higher entry barriers, right? So there's a lot of investment required in equipment, etc., bunkers, infrastructure, etc. So to that extent, the patients do gravitate towards, bigger players.
Sure. And is it possible to share the split of this 25% of revenue mix between, let's say, surgical and non-surgical? Because we also have chemotherapy and radiotherapy included in this 25%. Right?
Well, that's not a public number, but I think obviously a large part, I would say not be, so it will be a large part of this will be chemotherapy, right? But I would say it's a fair share of all three, radiation, surgical and medical. Now we haven't publicly given that number.
So we won't publicly disclose the split between the three.
Sure. And is it fair to say that oncology would be highly accretive to profitability for us?
Yes.
Now, yes, the oncology happens to have higher ARPOB, right? So to that extent, yes, it will be higher profitability also.
Sure. And second,
it also occupies more space. So, there's also a return on capital and return on real estate over there.
Okay. So return on capital is also higher in your view, or does it require more space so it would more or less in line?
I think return on capital, it's even with the rest.
Okay. Great. Thanks for that clarity. And secondly, on drivers of a strong ARPOB growth of around 13% year-on-year for the first half. If I kind of do some back calculation using the bed share and revenue share, it seems that CGHS ARPOB or institutional ARPOB would have at least gone up by around 20-25%. Is that a fair number, or I'm overestimating, underestimating?
That's right. I think the PSU ARPOB has gone up by 28% exactly.
48% for the first half.
48% Y-on-Y.
And that's not because of pricing.
Yeah, it's also because of the mix
change, which I was mentioning earlier. It's a change in mix. It's not a change in price. The change in price will not even have a 14 crore sort of impact on your overall revenue.
Okay. Perfect. Thank you. I have more questions. I'll get back to you.
Thank you. The next question is from the line of Bino Pathirampil from Elara Capital. Please go ahead.
Hi, good morning and congrats on a great set of numbers. Just one question on the expansion plans. For all the facilities, the greenfield facilities that are coming up over the next couple of years, so what's your internal target for EBITDA break-even? In how many months or quarters?
Almost 90% of our expansion is brownfield. And normally we see EBITDA break-even in a quarter or two, if not the first quarter itself. But the last experience was to get EBITDA break-even, we were hitting 40% margins within 40 days.
So your question was on greenfield facilities. I think on greenfields, we do see 11, I think within the first 12 months break-even, that means 11 to 12 months should be the break-even EBITDA.
That's 10% of the total expansion is happening.
Okay. Understood. So within a year for greenfield and within a quarter for brownfield. Okay.
That's it. Yeah.
Great. Thank you.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking my question. Abhay, can you give us some numbers on what has been the increase in discharges, inpatient discharges of QOQ and YOY?
7%.
This is YOY.
That's right. QOQ seasons matter simply because you have medical patients, etc. So when you have more medical patients, your discharges because your loss is lower, discharges may be the same. Look at everything on a year-on-year basis. This is better service.
Okay. And secondly, on the the seasonality part of it, typically, how should one think about seasonality in our business? Q2 obviously is bigger than Q1, and how should we think about the rest of the year with respect to Q2?
Well, see, Q4 is the best quarter in a year. Q2 is the second best quarter. Q1 and Q3 are weak quarters, and that's seasonality in the business and happens every year. Typically, your H2 is better than H1.
Okay. And I guess given the way things are, that's a trend we should follow even this year for us.
That's right. I mean, unless something disruptive happens, that's typically the secular trend in healthcare is H2 is better than H1, and Q4 is peak because the burden of disease, etc. Also, your Q2 is the second best simply because you have the seasonality due to dengue and vector season, and Q1 is weak because you just had increase in salaries and fixed costs, etc. on the 1st of April, so your margins are kind of squeezed. And Q3 is the festival season, which is Diwali and all of that kind of stuff.
And secondly, on your expansion plans, barring beyond what we've already outlined so far, how are we thinking about expansion? We've got enough cash reserves on books now. In terms of the inorganic growth opportunities which are there, how have you seen the landscape playing out? There've been a lot of private interest in the space, which probably would have created own challenges for value buying. So how are you looking at the inorganic growth opportunities outside of NCR?
So I think there are quite a few. I think there were 20 odd cities that we are looking at, and we've been busy at it, and hopefully in the near future, very shortly, we should come up with some surprising stuff. But there's been a lot of this thing on the. I mean, we maintain some fiscal discipline and don't want to run fool's errands by the end of it. But there are quite a few amount of opportunities, both on the build side, partner side, on the asset light model, as well as certain acquisitions as well. So we intend to deploy this capital.
Okay. And last one, on the Shalimar Bagh expansion that we did in brownfield, what is the capacity utilization on that?
78% on the overall, new and old combined.
And when you would have put the new capacity, the older one would have been closer to 80% plus.
80 to 83%. Yeah.
Okay. 80%. And just sort of reconfirming on the incremental beds, we're making right now 40% incremental margins.
Yes, that's right.
And how do you think
within 40 days of opening those beds?
Right. And in your assessment, incremental brownfields that we're going to be putting out, how should we think about? We did talk about the first quarter break even, but in terms of is Shalimar Bagh an exception in the way it's played out, or this is going to be a template that's broadly going to get replicated across the new brownfields?
Look, honestly, I think that's been what the Shalimar Bagh experience was the experience in Vaishali before that as well. Because I think theoretically you're tapping into tapped demand on your doorstep to start with, and then you have operating. You don't have any real fixed costs with those incremental things. Theoretically, it should be. I mean, this should be the template. I mean, I don't see that changing.
Oh, perfect. Yes, that's interesting. Thank you very much.
Thank you.
Thank you. The next question is from the line of Ankur as an individual investor. Please go ahead.
Hello.
Hi, Ankur.
Hi. See, I think my question is partly answered in one of the previous questions that was raised by one of the participants. Really, it was about the last 2 years. There's a bit of a concern that we haven't acquired any project and added anything onto our already announced development pipeline. And obviously, we've been running an under-leveraged balance sheet for a while now, and then now we've got all this cash accumulating. And you've talked about, acquisitions, M&A and all of that. But, I mean, it's 2 years since we added anything. And also on the greenfield side of things, are we looking at, any greenfield projects that we want to add? And I know you keep saying, like, imminently that there should be some announcements. But, it also takes about, I think, if you add a new project, a greenfield project, about 3-4 years before it's operationalized. So if you can throw some light on all of these things, please.
Yeah, I think there's always a tug of war between the desire to expand and fiscal discipline. And one has to maintain that. It's not as if we haven't been this thing. We kiss many frogs before we find the prince, and we are at it. And we are quite certain that shortly we should be able to deploy. Do keep in mind it's not a huge amount of cash, because even to construct a 500-bed hospital, you will take about 1,000 crores, right? To acquire a 500-bed hospital will cost you another maybe 1,015 to 1,500 crores. So, one or two acquisitions and you're done. So, at one side we are sort of excited about the fact that we are accumulating cash, but we are also conscious of the fact that, this amount of cash and even the ability to leverage is not going to take you very far. I mean, today transactions are available at 15 times, 16 times, let's say, EV to EBITDA. What that means is even at entry, we'll be able to buy, even if I was to go and spend 5,000 crores, right? I mean, we can invest, what is the math on that, divided by 15? About 200 crores EBITDA. That's about 10% of my total EBITDA. 300 crore EBITDA. That'll be 15% EBITDA. So I can increase my EBITDA by 15% by deploying 5,000 crores. And that would pretty much use up all my cash and my leverage ability.
Okay.
Right? So I think, it's important to, while we notice that there's amount of cash which is being accumulated, do keep in mind it is a capital-intensive sector, one. And secondly, there are massive amount of opportunities in the sector yet. So if we want to sort of participate in that, we need to accumulate the cash and spend it with the right amount of fiscal discipline at the right time.
Yeah,
for sure. There is money, but not that much money also.
Yeah, and also, as the way we've been going, and it's about almost, let's say, 20% sort of EBITDA growth, cash flow growth over the last couple of years, and going forward also, it seems we're going to continue on that trajectory over the next 4 or 5 years. So then beyond that, to continue going at the 20% sort of rate, we'll also need to keep adding the bed capacity at that sort of rate, right? So we need to have like this continuous development pipeline which keeps, every year keeps adding projects year on year so that, the growth continues for long duration. So I'm sure you guys are working on it, but just, and you mentioned like you're looking at 20 cities, but there has been no actual project acquisition. So that was my only question, but yeah.
No, but you're absolutely right. Just keep in mind two aspects, right? In the last 2 years, there's not been any significant capacity expansion. That's right?
Yeah.
Yet you're seeing a 20-odd% increase in EBITDA.
Yeah.
In the next 3 to 4 years, you're going to have 25 to 2,700 beds coming. You're increasing your capacity, 85% of it is through brownfield. That is almost like doubling your capacity over the next 3 to 4 years.
Mm-hmm.
Those are coming on stream. So shouldn't that be giving you expansion for the next 5 or 7 or 10 years itself? And increasing given the fact that your break-even is so short in these brownfields, it'll add a bunch of more cash flows for your listing, which again, all of it gets deployed and gives you further listing. So look, I think there are 3 streams of growth over here. One is your current bed capacity, which has been growing in terms of EBITDA. Then all the expansions that are already being announced, which have already been underway, which we said are largely online. And the third is what you want to do with this cash.
Mm-hmm.
right? So, I mean, it's an exponential 3x strategy. It's not a strategy with a 15-20% growth. I mean, if I was not to sort of deploy this cash, give it all back as dividend, yet you will be doubling your capacity over the next 2 years. Or 3 to 4 years.
Yeah. I think that's it. I mean, from my side, I understand where you're coming from. It's and also it's clear, like as the cash flow keeps accruing over the next 3-4 years, and they keep growing, you continue to add on to your development pipeline and continue this growth for long term. So that's it from my side, and thank you and all the best.
Thank you. Thank you, Ankur.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
So thanks for the opportunity. So just on the organic basis, on EBITDA per bed, while we've already, I presume, optimized in terms of efficiency at the overall level. So how do you think about the levers for improving EBITDA per bed for next 2 years, 2 to 3 years?
I think EBITDA per bed now, the first half has already happened, right?
Right.
And your second half is usually marginally better than your first half and so on and so forth. I think for at least for the rest of the year, some sort of trajectory is being already articulated.
So more from, let's say, beyond FY24, how do you think about it?
Sorry, more from?
Beyond FY24, how to think about it? In the sense, the case mix or the payer mix is also we have already taken good price hike on account of institutional patients. The insurance penetration.
No, it's not a price hike. In fact, it's only 14 crores. There's a 28% increase in ARPOB, and that's really due to the clinical sort of this thing. Because you're moving into higher end procedures. You're distilling procedures.
Right. Okay.
The price hike is being negligible, in fact. Yeah. Of the 28%, only 5% is the price hike, in fact, in the PSU segment. In the PSU, like Yogesh rightly pointed out, only 28% increase in ARPOB in PSU, only 5% is being due to price hike.
Right. No, I meant to ask that how much more can further be optimized, if not on price hike, but other levers, so as to drive the EBITDA per bed, maybe in mid-teens or more or less growth over the next 2 to 3 years.
In a similar fashion, as your payer mix sort of starts moving up on a particular trajectory, your clinical mix moves up on a particular trajectory, all of it flows to your EBITDA. Your indirect cost is increasing by maybe 6-odd% every year, 6-7% every year or whatever. The difference between your revenue increase, now you have to make an assumption of the revenue increase. The difference between that and the indirect cost increase is all flowing down effectively.
Got it. Understood. That's it. Thank you.
Thank you. The next question is from the line of Bansi from JP Morgan. Please go ahead.
Hi, thanks for the opportunity. So I have one question, and this is on the advancement of robotics that we've seen in the overall healthcare space. So we've seen more and more specialties using robotics, and even the non-complex ones, are making use of robots. So in general, where are we today in terms of, surgeries which are getting done on robots, and what's the scope here, where it can go to? And also, will this be, I'm assuming this will be lucrative enough. So, what is it in terms of, ARPOBs and, margins, how different they are, compared to our traditional, surgery work?
So I think first and foremost, although robotics has been around for some time, over the last couple of years, there's been a sudden uptake of that, and acceptability between doctors and patients both has been quite dramatic as far as robotics is concerned. I mean, to be honest, it surprised us also on the upside. I mean, like I mentioned earlier, our total number of robotic procedures have more than doubled in the last 1 year. And, it's been a pleasant surprise. Most specialties now, you get into this flywheel concept as the acceptance sort of this thing. We are being pushed by many of our hospitals and many of the clinicians now, to set up robots, because then frankly it's become more and more viable. What happens is, of course, it's at a higher cost compared to, laparoscopic or even for that matter, a general surgery for the same thing. But, and so it leads to higher RPOBs. But the contribution levels from robotics are lower. And EBITDA in terms of margins are lower in percentage terms, although in value terms are higher. And this is something that Bansi had previously mentioned with respect to both higher-end payer mix and clinical mix, that you get lower percentage margins but higher value in terms of absolute EBITDA coming from this. What is that?
Yeah, it also helps us in terms of reduction in ALOS, right? So EBITDA per bed is obviously better. But in terms of margin, that may be probably lower than the overall average.
But a little difficult to right now sort of present a trajectory. Where do we see the growth happening, and will it continue to be 100% growth, or will it repeat it down to 70 or 50%? But or will it increase from here?
Got it. But the adoption has increased, and in general, it also improves your throughput, right, within a particular specialty.
That's right.
Okay.
That's right. And overall, it's it's got all the sort of positives with it. As public acceptability sort of increases, space technology advance, there are entry barriers in this. The smaller sort of places can't adopt it increasingly, and awareness increases. Then you see this move towards larger hospitals and more sophisticated healthcare systems.
It's also better medical outcomes. Good for patients.
Yes.
Got it. Thank you. That's it from my side.
Thank you.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is a follow-up question from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Thank you for the opportunity again, sir. So one on Dwarka. So as we are kind of getting closer to the commissioning of the facility, would have we started hiring in terms of doctors for key specialties, nurses, paramedical staff, or would it be more closer to the commissioning?
No, so we started all of that, and I think we've, or at least all the head of the program and functional sector already in place, and they've been in the system. As we speak, they are working in some of our other facilities. And so as far as the soft power is concerned, the people are concerned, the sector, all that is in line and schedule. So there's no lull on that. And there's enough availability and excitement around this facility from a clinician standpoint.
And would it be more like a staggered hiring in terms of specialties, or we would go with the full-fledged 300-bed operationalization on day one?
So now you do about 150 odd beds, 164 beds we are doing, to be precise, like you pointed out. So 164 day one, and as you require, you sort of open up more and more.
Okay. And one follow-up on the robotic surgery, while you have alluded that it's good from the ARPOB perspective and the absolute data perspective. But in a longer term, if let's say even the other hospitals also kind of start affording it, does that bring them to the equal level in terms of surgical outcome, etc., and then the importance of brand or surgeon skill kind of get reduced? Do you see that happening?
Not particularly. I think the market is growing. There's only those many players which can adopt robotics, because it's also people have to be trained on it. You have to have availability of their talent to be able to do this. So all of that will take time, but I think more and more before that your market would have expanded. And we've seen this, right? Why robotics? As far as any technology is concerned, the larger players sort of adopted first, the smaller players adopted thereafter. The market continues to expand. But I've never seen the larger players sort of market share go down because the smaller players have adopted the technologies thereafter. I think you kind of increase the size of the market. All the smaller players also have a hand in increasing awareness for that product.
Sure. And for us, is it more like a capex model, or is it more pay-per-use model?
Actually, we surprised you asked. We started this off as pay-per-use because we were quite unsure. But we've actually bought more than 50% of the robots recently, because it's kind of surprised us in any case. So at this point in time, we have a hybrid simply because we started off by pay-per-use, but now we got into buying it back. We bought more than 50% of the robots that we have.
Okay. And return on capital is higher on the...
Of course, that's why we are buying.
Okay. Perfect. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Naisar Tariq from Native Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. The first question was on the overall industry trend. Are you seeing still there is a gap between supply and demand growth, and do we see for the next couple of years there will be leverage to continuously grow price and ARPOB? How are you seeing that?
I'm not seeing it over the next couple of years. I'm seeing it over the next few decades. I think this is a multi-decadal opportunity. There is huge amount of under-penetration. There's a massive gap between supply of quality healthcare and demand for quality healthcare, which is only increasing as we go by. And that's the reason, and India perhaps offers this opportunity which nowhere else, no other country, no other health system in the world does. I mean, you have at one side you operate almost like a utility because you have the sort of it's inflation-free, it's insulated business, but at the other hand you also have this massive growth opportunity because of just the sheer lack of penetration or availability of quality facilities.
Got it. And on the international patient side, you said around 5.5% of your beds. Is there scope for that to significantly go up to say 10% or higher? And how are you seeing the international traffic on the clinical side?
It's grown 25%. Traffic has grown by 25% in revenue terms at least over last year. Okay, even I suspect even in terms of total number of bed days, that means in terms of volume of patients also has grown by 25% over the same quarter last year, and 11% over the last quarter itself. And do keep in mind this is 12% of our total business, which Afghanistan is down to zero. I mean, if you assume that coming back to normalcy, I mean this would have been an increase of 30% over last year, or more in fact. So where does this train stop? I think we haven't even scratched the tip of the iceberg. This should continue in my mind, but at a significantly higher pace than the rest of the hospital growth.
Got it. And the 2,600 bed expansion that we have, can you just give some idea in terms of how much can come in the next 6 months and how much in 25?
So 300 beds should come in by end of FY24, current fiscal year. FY25, towards the end, you will have another 350 beds of Nanavati coming. Then Mohali, another 200 beds. 300. Where is that? That one. Again, same time next year. And Gurgaon, same time next year. So you have about 1,000 beds coming in the next 1 year. 1,300 in fact. 819 beds, sorry.
So 300 by the end of this year and another 800 to 900 by the end of next year, right?
Yeah, it's on the presentation on the website. You can see it. I mean, it's a quarter by quarter expense and date of commissioning.
Oh, okay. Got it. And just one last data point. You said the institutional ARPOB obviously has improved significantly. So now, where does the gap between institutional and non-institutional ARPOB lie? Roughly, what would be the gap?
85%. Somebody asked the question earlier. 85%. If for institutional it's 100, for non-institutional 185.
Okay. Thank you so much.
Thank you.
Thank you. The next question is from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Hi, thank you for the opportunity. So you mentioned about expecting to make some announcements on the expansion bit shortly. So just wanted to check when it comes to different expansion models, like say between partnered, build to suit, O&M and acquisitions, do we have any specific preference?
No, I mean acquisitions are at the right price or this thing, but otherwise build to suit in the sense the asset light is very good. Well, we don't like greenfields.
Understood. Okay. And on that point, on this care acquisition, you have been providing regular updates, including one yesterday night. Now, on one hand, the appeal is reserved for orders, and on the other hand, Blackstone seems to have announced the acquisition, at least as per media articles. So, not sure what to make out of this. Can you please help elaborate on the current situation?
I mean, the situation is what it is. We've made an appeal to the High Court. Now it's for the High Court to decide.
Understood. Okay. And one final question.
I can't give you any opinion on that. No? I mean, for the judge to decide.
True. Okay. And Abhay, one final question. Now, when it comes to some of these allied services, we are into diagnostics, then at home. But we have seen some of the other hospital chains doing far more as far as some of these allied healthcare services is concerned, getting into pharmacies, then insurance, diagnostics in maybe a bigger way. So maybe in future, not immediately, but in future, are we open to being more aggressive on some of these allied services?
I am open to anything and everything in the healthcare business, okay, which others have succeeded in. Philosophically, we don't like to do pioneering things. When they succeed, we will study, we will learn from their mistakes, and we will gain confidence from what they got right, and then we will do it better like we do. Okay? So anybody does it, I'm very open to doing those things, but let somebody else do it, successfully first. I mean, there are more than enough examples in front of you where people have, jumped into a situation and got it wrong. And that's not a game we play. That's not what we're good at, to be honest.
Fair enough. Okay, that's it from my side. Thank you.
Thank you. The next question is from the line of Amit Kavani, as an individual investor. Please go ahead.
Hi, Abhay. Thank you for taking my call. My first question is that I don't know if it's already been asked and have you answered it, but the revision impact on the institutional business, can you tell us what it is expected to be in the December quarter and March quarter?
I have no idea what is expected to be because they haven't, taken us into confidence on that. So far, the impact has been 5% of ARPOB of the PSU business. But we have absolutely no clue how the government is thinking about it.
So no further any institutional division has been announced, basically.
No, we were told we were expecting it this quarter, and now hopefully we are expecting it next quarter. But we don't know when it will come through and how much will it be.
Okay. The second question is actually, when I speak to other hospital companies who are not really in metros, they say that the institutional business does not have lower margins than the overall business. So just trying to understand the kind of, the difference between them and us. Is it just because that we are in metros that our our non-institutional business is higher paying? Is that the conclusion to reach?
No. Look, the institutional business, let's say, has an ARPOB of, let's say, 40,000 odd, right?
Mm-hmm.
If the rest of your business, for whatever reason, has an ARPOB of 40,000 or lower, okay, then it doesn't impact you, does it?
Right. So
ARPOB is the highest in the industry. Now, why is that? A lot of players have an ARPOB of 40,000. Now, that should be a function of two or three things. One is that their clinical programs, okay, they're not doing high-end clinical programs like transplants, high-end oncology, etc. They are more medical patients. Okay, their payer mix, okay, is not very distinct. They don't have international patients, they don't have cash-paying patients, insurance patients to that extent, and whatever else it is.
Right.
Substitution of institutional isn't there. So obviously, for them, there is no benefit in
But the question actually is that suppose if someone has a hospital, let's say in Ranchi, which is like a tier 2 city. So, will the CGHS compensation to them be the same as another hospital in, Saket?
Almost same. There's some difference in the NCR price and non-NCR price, but I would say not a great difference.
Negligible difference. It will be the same. So Ranchi people will do it. The only difference is Ranchi there won't be too many CGHS additions, right?
Got it. Thank you, Abhay. Thank you.
Thank you. The next question is follow-up line from Kunal Dhamesha from Macquarie. Please go ahead.
Thank you, sir. So on the CGHS and self-pay ARPOB, we have said the difference of around 85%. Can you also quantify what would be the difference for the international patient? So if let's say CGHS is 100.
International patients typically be 1.5 times of the cash and insurance. So that means domestic patient versus TSP out, domestic to international will be 1.5 times ARPOB.
So could it be roughly around 250? Like if CGHS is 100.
CGHS, do the math, na?
So I'm saying
if CGHS is 100, that is 185. This is 50% more than 185.
Yeah.
Okay. Perfect. 275 then. And these are the numbers for H1, I would say, or like more or less this remains.
The current numbers, running numbers.
Current numbers. Okay. And secondly, on CGHS, you said that on institutional, you said that we are now taking higher complex procedures, etc. So do we have the flexibility, to choose on the specialty on CGHS or some of the institutional business?
Well, we all inherently do because some of the hospitals have now disengaged, and our hospitals which have engaged don't have those vessels on sometimes facilities.
Okay.
There is a churn which happens.
Okay, so basically some word of mouth, something, more people.
Not word of mouth. Like Max Saket now only does cardiac and oncology. Has stepped out of CGHS on all other things, etc. That's the main hub. So you start moving towards that.
Okay. So we have the flexibility of, saying no to other specialties.
It's not a question of flexibility. It's a matter of contract.
We told them that we can't treat patients, right?
No. We've entered. Our contract is amended to this thing. It's not a flexibility that you have. We have the flexibility for all of it, and you do all of it.
Mm-hmm.
Can't start cherry-picking as for whatever arrangement you have.
Okay. So our contract is only for few specialties where we have, strong base and more complex. Okay. Perfect. Thank you.
Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference back to the management for their closing remarks. Thank you, and over to you.
So thank you all for coming on to Max Networks Q2 fiscal year 2024 results. We will look forward to seeing you for our next results. Thank you very much for that.
Thank you very much. Ladies and gentlemen, on behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.